Hi, good morning, everybody. Thank you all for joining in on Saturday morning. So today's topic, again, it's hybrid funds and overview. So I think a couple of weeks back, when I was doing the webinars, there was a comment that said, I want to look at what hybrid funds are. And so I thought that, okay, let's just do a small presentation of, looking at hybrid funds and whether it is a good opportunity for investors to invest in or not. Right. But before we go in, these are our regular slides that we stand for. So what is a market cycle? So market cycles are predominantly driven by greed and fear. So this is greed basically is that when you see a lot of investors in the equity market participating in the equity market, giving you tips, speaking a lot more in social outings. It's a trend. You can see it everywhere, and that everybody, that fear of missing out is there. Where investors do not want to miss out, so they start putting more and more money into the market while the market has been performing very well, right? So there is a period of optimism and then a period of over optimism, right? Then comes a period where everybody is very scared. They do not want to put their money into the market. They want to take out money from the market no matter what the case be. So that is a case of pessimism. And then there is a case of over pessimism, right? So which means extreme fear, right? So market cycles do work in uh, ups and downs, and this is true across all asset classes, right? So for equity, yes, there will be a different cycle. For debt, there will be a different cycle. For gold, there will be a different cycle, but everybody goes through a particular cycle. Now what Milestones 12 does is that we are not a buy hold sort of a platform. We are a behavior oriented program, right? Where the model is that in times of fear, is where we want our investors to participate a lot more, which means their participation has to come from in forms of lump sums, in forms of SIPs, in forms of step up SIPs, right? But the whole idea is to capture volatility at that point of time, so that when the exciting market does come in, you can reap the entire benefits out of it. Right now, reap the benefits out of it doesn't mean that only when the market is at peak you will take out money. Yes, that there is a case when there is overvaluation, that is over optimism in some places, is where you have to just start trimming down your positions, move to safer parts of the market where there is a boring market, right? So move to safer parts of the market is one, and second is when your milestone or your goal is met. Now we've set a target that for every investor that we want to work with, we've set a 1 crore target, right? So we handhold you to take you from 2 lakhs, 5 lakhs, and then to 10 lakhs, to 25, then to 50, and then to 1 crore, right? So it's majorly a behavior oriented program, right? Where we have multiple checkpoints. We take all decisions based on your risk profile. There is a financial health checkup that says that this is your potential, this is your current savings potential, and what can be your sort of future savings potential, right? And only then starts investing for you. Make sure that your first line of defense, which is your insurance, is covered. Your contingency reserves are well set up, and only then have a holistic view in building wealth, right? So that's what Milestones to Wealth does. Right? Now let's take a poll. Have you ever invested in a hybrid fund? Yes or no? You can put it in the comment box saying yes or no. So there's one comment that says yes. There is there are two comments that say no. Okay, very good. Now we'll look at how many types of hybrid funds are actually there? See, I think first we should get clarity of how many hybrid funds are there. Usually we see categories like hybrid, balanced, advantage. All of that starts coming in, right? But we should actually know as to what are the categories that are actually available to us to invest in the hybrid category. So if we look at this, this is SEBI's classification of hybrid funds. They categorize it into 7 subcategories. One is conservative hybrid, which will invest 10 to 25% into equity and the balance in debt. Then there is balanced hybrid, which will invest 40 to 60% in equity and the rest in debt. Then there is aggressive hybrid, that's what we were talking about, right? Where they invest 65 to 80% into equity and the rest goes in debt. Then there is balanced advantage fund, where it's dynamically managed, right? Where it can go 0 to 100 in equity and it can go 0 to 100 in debt. Right? Now, this is a very, very good option for investors to take a look of 0 to 100. Right. So it's not fixed, which means you don't have to always commit to equity when there is periods of over optimism or greed, and you don't have to overcommit. Likewise, on the debt side, when your rates are not very conducive for you to invest in debt, right? Then there is multi-asset allocation funds where they say investment in at least 3 asset classes with a minimum allocation of at least 10% in each class. So I can have debt, gold, and equity, but I need to have a minimum allocation of at least 10% in each of these. Right? So minimum I need to have 10 in each of these. Right. Then there is arbitrage, which is again more equity in nature, which is 65% in equity and equity related instruments. Right. Then there is equity savings, not a very famous category, but they do have a minimum of 65% and a minimum of 10% into debt. So they cannot go below that, right? So uh, they have to have that particular allocation that they've set for that particular asset class always, right? Now, what are hybrid funds actually, right? This is as per AMFI's definition, that hybrid funds invest in a mix of equities and debt securities where they seek to find a balance between growth and income, right? So they basically there is a regular income that they earn from debt instruments for stability. Then there is a portion uh, that goes into equity, which is majorly for growth, right? So AMFI says that for a hybrid fund, they should have both growth investing and income investing, right? So basically, it should be the return should be somewhere between 10 and 12%, because that is what balance means. And volatility of the fund, which means the inherent risk of the fund, should be lower, right? So higher the allocation to equity, greater is the risk, right? Now, let's look at where the money is within the hybrid category, right? So if you see in the multi-asset allocation side, right, the number of schemes in the last 2 years has gone up. Sorry, apologies everybody. I was just having a little bit of audio issue. Thank you so much for waiting up. So yes, what we were seeing is that so you see the number of multi-asset allocation schemes. The total number of schemes last 2 years has actually gone up. 10 was the number in 2022, and today, as of last month, that number is 24. Right? If you look at the net AUM also that is being managed by the multi-asset allocations fund, it's somewhere between 34,000 odd crores, right? So it has actually gone up from what it was in 2019, right? And if you look at the flows, a lot of flows has been going into multi-asset allocation theme, right? So that was what the question was even at that point of time, that there's so much money going into these hybrid categories. There's so much money going into multi-asset allocation funds. Is it actually worth looking at these funds? So right, so let's look at some slides on hybrid and then some slides on multi-asset allocation, and then see where it actually sort of fits into an investor's portfolio, right? So why do we look at hybrid funds? One, so there are four reasons, right? One is that yes, you get a mix of actively managed equity funds, equity that is stock component, which is majorly large cap oriented. Then there is a high quality debt portfolio, in the scheme itself. So there's a good balance. One important thing is that there is equity taxation, right? So since it maintains, a high allocation towards equity in the range of 72%, somewhere between that, that's what the average looks like. The fund is taxed as an equity mutual fund, right? And then just like any other mutual fund, you can actually go out there and do your SWP, right? So your growth is balanced. At the same time, there's lower volatility, and you can take advantage of SWP. But main thing is that this category is taxed as an equity mutual fund tax, right? So if you look at how equities do over a long period of time, let's say a 100% equity portfolio, see the 10-year returns from a CAGR perspective is somewhere around 11.8% to 12%, right? But the volatility is significantly higher. Now, volatility basically means your risk, right? So the risk is significantly higher, right? And then when you look at the debt component, last 10 years CAGR has been somewhere between 8%. So yes, your GSEC is somewhere between 7.5%. So naturally, long period of time, 8% odd is what you would sort of make, right? And your volatility is far lower. So let's say if you have a 65% equity portfolio and a 35% debt portfolio, what happens then? What happens then is that the CAGR is somewhere between 10 and 11%. So basically you make just a percent or so lower, right? That's what has happened in the past, where you just made a percent or so lower, with lower risk than what you would do in 100% equity product, right? So you're making more or less the same return of an equity product, which is a 100% equity product, by taking much more lower risk. Now, this lower risk component is the underappreciated part, right? Because here, when you're taking higher and higher risk, you should be compensated for much more higher returns, right? But that's not the case for equity. And going by what's happening today, that's not going to be the case also for the next couple of years, where they continuously keep on taking higher risk, where investors keep on taking high risk in the assumption that they would be rewarded much more higher, right? So it's a very similar case now, right, where future returns again are getting discounted today. So there's a lower scope of them making high double digit returns, right? But when you look at a mix of say equity and debt, which is what we are looking at a hybrid, right? So multi-asset would have three asset classes, right? So you're making somewhere between your equity return only, but at far lower risk, which is a very, very big plus point, right? Then it actually provides a cushion in terms of a drawdown, right? So when you see equity market drawdowns have been very, very sharp and very, very deep, right? But since there is a component of debt and debt does well when there is a downturn, naturally that cushion is what is saving an investor during such bad times. If you see, in between 2019 and 20 March 2019 and 2020, your equity markets went down by 24%, but your debt market actually had gone up. So there was a debt rally of 13%, right? So that actually cushioned the blow when you're overweight on the equity market, right? So there's a good amount of cushion that hybrid funds are actually able to provide to you. Right. Now, when you look at multi-asset allocation funds, right? So this is a study that that PHB had done, where the study published in 1996 states that asset allocation is the single most important decision that explains portfolio return variability. So when you see, why somebody else has a, better return than you do, it has nothing to do with what they're buying, or it has nothing to do with when they are buying it. Right? It all has to do with asset allocation, which part of the asset category were they invested in at what time, right? So for example, at some periods gold does extremely well, at some periods equity does extremely well, at some periods debt does extremely well. Right? Now, when is that? Now, if you see and all of this is public data, if you see over the last 22 financial years since 2003, equity has been the best performer only for 13 years, right? Which is almost half, more than half. But there are places where debt and gold have been the best performing asset class in 2 and 7 years. So gold has actually been the best performing asset class for 7 years out of the 22 years, which is again an extremely high number. So if you see when this has happened in 2008, this has happened in 2009, this has happened in 2011, this has happened in 2012. Again, this has happened in 2016. Then this has happened in 2020. Again, this happened in 2023. Right? And if you see, what has been happening throughout, you are seeing a lot more stability coming in on the gold side, where central banks are buying in more and more gold, and that is actually leading to a good amount of performance for gold investors. Right? So the problem with investors is that there is a bias towards asset classes that actually perform very well recently, which means that the lot of flows go into equity when performance starts coming. So if you see small and mid caps, they have performed extremely well. So a lot of money keeps going into small and mid caps. Right? Whereas for large caps are actually seeing an net outflow in AUM, and investors are shunning away the large cap space, whereas large cap is becoming more and more of a value oriented buy right now. Right? So recency bias actually results in investors chasing momentum and picking an asset class at the wrong time. Right? So what multi-asset funds do is that since different asset classes outperform at different times, they would have allocation towards these assets, so that asset allocation mix actually goes out and performs for you. So let's look at how it is actually going out and performing for you. Now, if you see, uh, if you have, if you do add 10% gold to your 50/50 equity debt portfolio, right, you would see drastic change in your returns. Right? So gold return is about 15%, your 35 to 65 is about 11.5. Then your 50/50 and equity debt is somewhere between 13%. Right? That's your return. Then on your equity debt, which is 65% equity, 35% debt, you have a 14% sort of a return coming in on that particular category. So what multi-asset funds aim to do is that first they aim to lower portfolio volatility, right? Which means not many ups, not many downs. Stability and consistency is what they look to offer. So that's one big tick mark. They aim to improve your risk return profile. Now, the most underappreciated part, right? You don't lose much, but you are able to gain a lot, right? For what money you're putting, right? You don't lose much, right? Aims to lower maximum drawdowns. Yeah, see, you don't lose a lot. You don't aim much. Right, so if you see, from a 50/50 equity debt, you see that the drawdown is about 30%. 65, 35, if you see the drawdown is somewhere between 36%. And this data is from 2001 all the way up until 2024. Right, so this is the maximum drawdown that, they have seen. Right, so that's what the variability looks like. Right, so asset allocation actually does a wonderful job in making sure that you don't see a lot of ups and downs. If you see even from this chart, that this particular fund, right, which is HDFC's fund, has lower volatility than your Nifty 50, which is your dark blue line. Then there is a 65, 25, and 10, right? So that is the orange line. So the orange line also has done extremely well, right? So there is a lot of cushioning that takes place within this fund, within the category, right? And then there is the fund. So apart from the fund, you look. This is not a recommendation for the fund, but if you look at the orange line, it definitely has a lower volatility than a 100% equity product, right? So that is sorted. So all of that is ticked, right? So any investor looking to make moderate return, right? At the same time, you are a conservative investor. You do not want to take much risk with your money, right? And you don't want to see much drawdowns, which means that in the event of a bad fall, like if you see in 2020, yes, you will have a lot of you will also go along with the market, in that direction, but definitely not in line of 100% equity product, right? But the main thing is that this is meant for conservative investors who are looking for moderate returns, who do not want to see much ups and downs in their investment value, right? So if you see here, how can investors implement multi-asset allocation, right? Work based on your financial goals, go based on your risk appetite. Optimal asset allocation is what they would do by themselves, so that's not going to be your problem. Rebalancing. Now, when should an investor go out and rebalance? Should an investor, I'll ask you all a question. Should an investor in a multi-asset fund, right, think of rebalancing? So you can put in your answers. Should an investor investing in a multi-asset fund or a hybrid fund think of rebalancing? Rebalancing means you are taking out your money and investing somewhere else. So there is a comment that said, yes, we need to rebalance when the need arises. Any other comments? Okay, so there's a comment. When equity valuation is low, we need to shift some portion of money from hybrid funds to equity. Okay, that we'll discuss in the Q&A. But yes, I do agree with you that there is a good amount of rebalancing that is required when the need arises. And that need is essentially your whether you're closer to your financial goal, and should this money go into pure debt funds, where you can have a plan for an HWP, right? But yes, there is a need for rebalancing, right? Even in a multi-asset allocation, yes, they would take care of the rebalancing part, but definitely always have a review of it, and see whether is it still in line with your financial goals and risk appetite, and whether there's a change required. But other than that, this is a brilliant strategy, right? Multi-asset allocation for wealth creation. This is the last slide. So if you see, no one asset class has consistently outperformed. That's why diversification helps. So rather than you taking that decision by yourself of diversification, there are multi-asset funds that do it, right? To stabilize portfolio returns, right? Uh, the main thing is that over a long period of time, it's not timing the market, or it's not uh, the fund or the scheme that you're investing, or the idea that you're investing in. It's majorly your asset allocation. So your asset allocation at a particular given time is going to determine your future returns, right? So for example, today we are taking a multi-asset approach on Milestones to Wealth, right? Which means that we are not investing in multi-asset allocation funds, though we are always on the lookout for very good opportunities. But uh, we want to have a disciplined approach towards asset allocation. We don't chase the performance. So you will have allocations that go directly into precious metals, into debt, into arbitrage. At the same time, you will have direct exposure that goes out to equity, right? So we want that level of control to take place within a particular category. So for example, on the equity side, we find that small and mid caps are continuously expensive. So we don't want much allocation towards small and mid caps at all. So we would like to be more, on parts where the market is not factoring in a lot of growth. It's more on the value oriented side, right? Second, direct exposure towards precious metals like gold and silver, uh, uh, rather than having a cap to say that no, there will be only 10 or minimum 10% sort of thing, right? So we would like that control to go overweight for more than 10% if the opportunity arises, right? Likewise, on the debt component side, there is a cap, right? So for a hybrid, there is a cap that okay, you need to have so and so, somewhere between 30-35% on the debt side. But what if there is opportunity and big opportunities coming in on the debt side for us to invest in, where there's no point to invest on the equity side, right? So we go 0 to 100, so we can go all in also on the debt component side, right? So what we want is the flexibility to allocate more and more assets towards a particular category. That's why we are looking to do multi-asset allocation internally. But as an idea, multi-asset allocation for wealth creation, multi-asset allocation is the only way for wealth creation, is what I would say, because it allows you to be a part of new winners every time. So that's the main part, right? You get to go from old winners to new winners very, very seamlessly, right? So it's very, very important for an investor to have a disciplined approach towards, asset allocation, and be consistent in saving and contributing towards that particular fund or towards that particular. So that will become your financial assets, right? So that will become your savings vehicle. So contribution towards your savings vehicle is more important for you than choosing where you should go out and invest, right? So now I'll open the floor for Q&A. So you can put up whatever questions you want in the chat box. So Maruti sir has asked a question: which fund is giving better returns at present? See, today If you go back and see the last 3 year returns anywhere, you would see small and mid caps coming up. That's one. Second, if you go on to Grow or Zerodha, wherever you're investing in, and you see the past returns, you would see public sector funds and defense theme come up in the last 1 or 2 years, right? So these are funds that did give returns, but at present, if you see, performance is majorly coming in from small mids and then flexi category, right? But we have actively stayed away from small and mid caps. We have found this space to be completely expensive since 2018. So we have actively stayed away from that. At present, these are themes that are giving good returns, but we do not judge based on returns. We are fundamentally oriented. So for us, we will only see how the portfolio of the fund is constructed, the fund manager philosophy, and whether it is in line with what we think an investor should do in this particular market, and only then take that decision. On asset allocation, uh, asset allocation is more important than hybrid / management. Which one would you prefer? So I would prefer multi-asset allocation. It gives the flexibility to add gold and other precious metals also if need be. So definitely I would prefer multi-asset. In fact, we have a multi-asset category also internally, which is Sphere, which is a PMS. And when we used to run the RIS service also, it's multi-asset. Milestones2Wealth also is multi-asset only. So I would choose multi-asset over all the other categories. So I'll put the number also of Milestones2Wealth. So if you do have any queries that are unaddressed, that's something that strikes you later, feel free to text us, send us a hi with whatever requirement you have, and our team will get in touch with you. Right? But do send us a hi so that at least you can come onto the system. And once your number comes onto a system, you'll keep on getting webinar invites from our side. You'll keep on getting content from our side. So you're all up to date with the content. I think Dinesh Kumar sir has asked, what are the factors to choose a hybrid fund? See, they are all very simple. See, majorly they will be large cap oriented. So anywhere where you see that there is less risk, inherently it's going to be less risk because the debt component will have majorly AAAs, right? So if you see that, yes, it's a well-made portfolio. It's a nifty 50 plus, nifty 50 plus, nifty next 50 sort of, basically your nifty 100 or your nifty 150 sort of a universe, and your debt also is somewhere between your AAA category, then it's a good fund to invest in. The quality of the fund is what I would say inherently is good when you have larger companies there. So that way it's a good factor. What if we have a multi-asset allocation individually, not with respect to mutual funds? How do you plan to organize? How do we organize the plan of investing? So I have gold and FD done. This is a very good question, right? Which means that see, this has to be done based on your risk profile. That's number one, right? So when you take a risk profile test with us, you will get a proper report of what is your willingness and your ability to take risk. Willingness means yes, that's what you want to do, but can you actually go out and take that risk is your ability. Right. So once that is done, then your goal. So what is your goal? Ultimately, how far is your goal? Right. If you see any, if you search for any asset allocation sort of content online, they would say have 5 to 10%, very generic, right? But what if for you require a higher allocation towards precious metals? What if you require a higher allocation towards debt funds, right? So it has to be tailor made for your needs and for your risk appetite, right? So that's why when you look at a multi-asset fund, right, it's very generic, right? But overall, they are ensuring that this is meant for conservative investors, so they would manage it conservatively, right? But however, for you, your need might be different, right? You might have a long way to retire or whatever goal be. Let's say your retirement goal or wealth creation goal, you might have a long way, 20 years or so. So naturally, a higher allocation towards equity would be preferred. That doesn't mean that precious metals should not be there or debt should not be there. Definitely, it should be there. But overweight should be on the equity side if your risk profile is permitting it. So first step, get the risk profile test done. Second, set your goals, and then it has to be tailor made. The split has to be tailor made for your needs and your goals. So you're already in touch with Nakul, have done some SIP. Should we have a meeting with other members of the team just to cross check uh, where I am standing in the yes? You can have a one-on-one meeting with me straight away, and I will convey this to Nakul right away, saying that yes, you do want to have a one-on-one meet, just to review where you stand. So you can straight away have a one-on-one call with me. So there's a comment that says, "Can someone please fix the M2W WhatsApp handle? It keeps repeating the same basic set of questions." Actually, even I also send hi to the WhatsApp handle to check whether it's actually working or not. And I too have the same feedback. So don't worry, the team is already working on it. But thank you so much for uh, your feedback. I too have the same feedback. Don't worry. So the one displayed no the one displayed is your number. No, that is our Milestones 12 number. That's not my number. Currently, most AMCs running MAF have reduced their equity exposure holding due to overvaluation. So what's your take and how is your funds placed? So our allocation towards so on the PMS, our allocation, which is the multi-asset PMS, our allocation towards equity has drastically come down. And the view for today's market is yes, things are still continuing to be very expensive. So it's naturally a good time for investors to take off money from expensive parts of the market and go towards avenues that are cheap. We have already discussed multiple times as to what avenue is cheap, right? So if you go back on the Milestones 12 YouTube handle and check on live, there are multiple webinars that we have done as to where that opportunity sort of lies in equity, in precious metals, in debt. So yes, it's a good time to take off money from expensive parts of the market and very expensive parts of the market. Our funds, we have drastically reduced our allocation towards equity or the PMS. and it's only going towards cheaper parts of the market. So do you guys have arbitrage position mixed with equity, since AMC is like, so we do take direct exposures on the arbitrage funds. So I have also done a webinar on the arbitrage side as to how much of an opportunity is actually there and how much of a yield investors can make and when they can make that yield. So yes, it does provide a very good opportunity for investors to invest in. So there's the question of, can you name two sunrise sectors which we can consider investing for long term? So today's context, for me, I would basket sunrise as it being cheaply valued based on based on moderate growth expectations that can come to us. Financials and financial services, is one part that actually gives a lot of opportunity for investors to take advantage of. Avoiding gold, do you recommend? Oh, sorry. Apart from gold, do you recommend any other precious metal? See, again, depends on your risk profile. It depends on what your goal is. If you're able to weather it, then yes, you can have more precious metals. But again, depends on your risk appetite. So is arbitrage an alternate to liquid in terms of taxation? What about safety, security? See, arbitrage should be considered from a your alternative to your short-term funds, right? Your ultra short, basically, right? So taxation is equity tax, so it's much better. Your yield is more or less the same. It would be today's yield somewhere would be around 7.7, 7.9. That's what you would make. This is pre-tax. So from a taxation part is definitely better, and it is a proxy to liquid. Okay, so Aishwarya has actually gone and put out. So we are having a physical meet in Chennai. So last time we had the conclave. So this is our second uh, physical meet one-on-one for Milestones2Wealth. So we have put in the WhatsApp number. Just send us a hi that you're interested in attending the conclave, and the other details will be provided to you. Right? But don't miss this. We are having this again, second time in Chennai. It's a physical meet. You can come in, have the opportunity to meet Sham sir, have the opportunity to meet the entire team that's working on building Milestones2Wealth from the ground up. So you will get a lot of opportunities, a lot of content also that's going to take place. Nagaman sir is coming, Aarti ma'am is coming. So there'll be a good full day session uh, on topics like financial planning that you can take advantage of. Is there a recording for non-Chennai? I don't think so. There will be a recording for non-Chennai. It's a physical meet. I don't think so that there will be a recording, but uh, I'll definitely give this feedback to the team internally to see if there can be done something, or is there an alternative for people who are not in Chennai. But follow us. You might actually get a surprise. So I'm actually teasing you, so you might actually get a surprise. Sure, Raja sir, I'm interested in this conclave. Already my contact is Abhishek. So yes, looking forward to meet you as well. We'll keep the floor open for another 4 minutes, and whatever questions you have, you can put it off in the chat box. Also, I'm adding another link here, which if you are interested in starting your account with Milestones2Wealth, you can use this to start off right away. You can use this to start off right away. What about SEBI's new asset class? See, in the developed markets, you have a lot of leverage options. See, for us, I think it's better since we are retail investors are going more and more and pumping more and more money in futures and options. It's better that somebody experienced actually does it for them. So in the long term, right, it's good. Right now, not much required, but in the long term, yeah, there is a lot of development that has to take place in the Indian markets, and this is part of that development. So let's see what the effects of this sort of development will be, positive or negative. But yes, rather than retail investors who doing, they don't need to actually be a part of leverage and leverage ETFs and inverse ETFs and all that. That's not actually good for discipline and behavior. But somebody experienced, it's good for advisors who have tremendous amount of experience and uh, this move basically means that you should always work with an advisor. You should not look to do things on your own. You should always look for expert advice. Yes, it's 10 lakh. How do you assess an AMC if the portfolio size is between 30 to 50 lakh per annum? See, if you have 30 to 50 lakhs per annum, don't worry. We can set a proper plan uh, based on your goals as to how much needs to be contributed to that particular goal. If it's a retirement goal, naturally we see that okay, these are the number of years that are there, and you will get a proper plan as to how much you can live off also off that entire corpus that we're building up, how many years you can live it off. So we will create a proper plan for you. Aishwarya, can you just check this message? I think he has posted the entire chat. Can you just check it and fix it? Sure, if there's any development that takes place for the new asset class and whether we will be participating in it or not, definitely everybody will know. So don't worry about that. Everybody will know. But that's quite far away. Right now, we would like investors on Milestones2Wealth uh, uh, to be the best set of uh, behavior investors, content investors in India, and help them on that journey to build a crore. You can register for the event. Uh, Definitely, you will get a link. Done. I don't think that we're getting any further questions. So thank you so much for joining in on a Saturday morning. Uh, uh, do register for our upcoming webinars. So there's one more at 11 o'clock, which is with Ramesh. So he is a very core member of Milestones to Wealth. Don't miss his webinar. It's going to be in Tamil. It's at 11 o'clock. So do register, do join in. Thank you so much. Have a great weekend ahead.